Hey, everybody. Good to be here. My name is Brent Moore. It's time for Get to Know Schwab.com. We're going to go through the Schwab.com website. Today, I want to talk about analyzing stocks on the Schwab.com website, kind of a focus on the fundamental analysis aspect of that. But I want to get beyond the theoretical of where and just where the numbers are, but what the numbers are and how they can kind of be used to help you decide whether they're stocks you own or stocks you're looking at, whether they're companies that may be of interest to you or maybe not of interest to you. But either way, I'm glad you're here, whether you're watching live or on a recording. And I'm joined alongside by my a good friend for many years, Mr. Cameron May. In fact, last night we had a dinner. We had a kind of group dinner, and Cam and I sat next to each other. So that was good stuff there, Cam. Cam's in the chat with me, so as you have questions, feel free to type that in the chat if you're watching live, and if you're watching a recording, make sure you follow us on X at Brent Moore CS at Cameron May CS. And before we get too far into this, let me just mention that the information today is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. And, all investing involves risk, including risk of loss. There are risks associated with investing in dividend-paying stocks. We'll talk about dividends a little bit here today. And some of those risks regarding dividend stocks include but aren't limited to the risk that the stocks may reduce or stop paying dividends. And of course, there's always the risk the stock goes way down too. So let's move on from there and let's head on over to the Schwab.com website. There I am. I'm on the Schwab.com website. Before we get too far into this, and let me just mention this. Goals today, we're going to talk about where to find kind of essential fundamental information, kind of point out there's so much information, you got to kind of be able to discriminate as to what's more important and what's less important. I'm going to try and point out some of the more popular areas that people look at and how that information is used. But let me just make a quick announcement here before we get into that, and that is, as many of you know, our webcast schedule is being tweaked a little bit starting the new year, and we got to keep up with the times and make things better and more relevant, and that's what we're going to try and do. And so there are a few webcasts, very very few, but this is one of those that is actually going away, but it's being replaced. We have new webcasts coming out. So beginning in January, in this time slot, we're going to be teaching an after-hours trading webcast. Okay, so in this time slot, 4 o'clock Eastern time on Thursdays. I'm looking forward to that webcast. I'm not actually going to be teaching that webcast. I have 3 webcasts I'm going to be teaching this upcoming year. Actually 4, because I do trader talks in the morning with Kevin Horner. I'm going to be teaching managing options portfolio. I'm taking over for Mr. Cameron May. I'm teaching advanced options strategies, and I'm also going to teach a long options webcast as well. So good stuff. We have some new webcasts, and some are changing, such as this one. We're going to continue to use and explain some of these great features on Schwab.com in our other webcasts, including the Getting Started with Stock Investing webcast and the Trading Growth and Value webcast. We use this webcast more. Also, remember, Thursdays, noon Eastern, we have our Schwab Center for Financial Research experts. They show you all sorts of tools using this website here. Okay, so let's move on and let's talk about finding stocks and analyzing stocks. Really analyzing stocks. Last week, Mike, who sat in for me because I was out, talked about using the stock screener. Now I want to go there quickly. I don't want to spend much time on it, because if you want a more in-depth session on using the stock screener on Schwab.com, just check out last week's session. It's in the playlist, just on YouTube or on Schwab.com/coaching. You can get past sessions and just go to last week's sessions. You got Mike Fairborn teaching about using that screener. So here's the stock screener. Let's go to this. Now, as I mentioned, if you want more on creating your own screen, check out last week's sessions. You can do that, create your own screen. That's not my focus today. What I want to point out to you though, is we have a lot of predefined screeners if you want to find stocks and you don't want to create your own screen. So you can see I've got, 8 right here, but if you click on view more, there's even more, okay? So I think 12 total predefined screens. And these sometimes can be a launching point for you to modify and create your own screen, okay? So let's do this. I'm going to go and I'm going to just click on growth at a reasonable price. What's growth at a reasonable price? Growth at a reasonable price is this. Sometimes we talk about growth investing, and to use my little tool there. Sometimes we talk about growth investing, and sometimes we talk about value investing, as they're kind of like these two completely opposite things, and there can be no overlap. Well, you know what? If this is growth investing and this is value investing, and this is our Venn diagram here, this is our GARP area here, growth at a reasonable price. So I'm not advocating that this needs to be the way you invest, but just realize sometimes you're not stuck in one camp or the other. That's what growth at a reasonable price is. So that's what we're going to be looking at here to start with, at least today. I want to click on that and we'll just see what we come up with. Now, maybe you like the results, maybe you don't, but what it does is it gives you the results and it gives you some relevant data. Some of the stuff that this is looking for, it looks for example, a price to earnings to growth ratio. Do you guys know what that is? So I know a lot of you are comfortable or familiar with a PE ratio. And sometimes you get higher PE ratios and sometimes you get lower PE ratios. And it's a little bit too facile to just say high is bad and low is good for PE ratios. What you're going to notice is some companies that you think are very good companies may have fairly high PE ratios. And some companies may have low PE ratios that you wouldn't want to touch with a 10-foot pole. And one reason for that is that companies that have higher growth potential or projected growth tend to have higher PE ratios. So if we were to factor that in, put that in the equation, and we take our PE ratio and divide it by our growth rate, or projected growth rate of what the company is going to do, that's where we get that PEG ratio there. And so that's what you can see this right here. And so that's kind of a good measure for a GARP type stock. And you can see other measures, earnings per share, growth history, return on equity, and so on. But here's some stocks. Some of these you're probably familiar with. Some of these I'm sure you're familiar with. I know you've heard of GM before, General Motors, and there's likely others. Hartford Financial, that's kind of a big financial insurance company. But there's some others maybe you're not familiar with, but this is a way of finding stocks. Now, that's not really the focus here, finding the stock. I want to talk about evaluating those stocks. So how are we going to go about evaluating those stocks? I'm going to start with GM because it's one, heck, you all know, but how would you evaluate it? So I'm going to click on GM, and just remember, these are just example stocks. None of these are recommendations here, folks. That's just, I need to say that. And any company you look at is going to have some good and perhaps some not so good as well. And we'll see that. And one place that a lot of people like to start is right down the middle, kind of the middle, like middle right of this page under ratings and reports. Now, I'm not going to go through these here, but just realize that that is an approach to helping you. I'm not advocating using that as a sole means, but just as a means of helping to inform your overall decision here. Okay, so let's distinguish for a sec about different types of trading. Some of you may be longer term traders. For longer term traders, anywhere from several months to indefinitely longer, as opposed to shorter term traders. And maybe I said longer term, I should say investors, shorter term traders. Generally, longer term investors tend to focus more on fundamental analysis. This is a generalization. And shorter term traders tend to focus on maybe a little bit more technical analysis heavy. But remember, technical analysis is not the sole means of investment research that you should be doing. But so I'm going to focus on more on fundamental analysis. And I would say for today, for what we're talking about here, when we're talking about these analyst ratings, probably falls a little bit more in that longer term investor camp here. Because in the short run, a stock does what it does, and whether it has good earnings or whatever, in the short run, it's a little harder for that to make a correlation between what a company's financials are and what it's doing over the next month. But in any case, so this is a place that you can look at. And if you want more in-depth information on these, and I'm not advocating any in particular, you can just click on where it says the analyst report or the stock report or whatever, the research. It's going to give you more in-depth information that you can read. And I'd encourage you to check that out. I don't care which one you look at. And remember, these are third-party analysts. They're not, they get it wrong. And they get it wrong too. So, but a lot of times, in addition to looking at what perhaps they give you a rating, a buy, hold, sell rating, or something like that. In addition to that, what they give you is more maybe color commentary on the stock, and a lot of people find that quite helpful there. Okay, let's move on. So after analysts, then one thing you may, pay attention to the right side of the column. If you want right side of this page, we have information on the company. We also have information such as the company's size. Here we have about a $55 billion company. That may sound astronomical to you. However, in today's economy with trillion-dollar companies, I mean, 55 billion may be nothing to sneeze at, so to speak. It's pretty kind of run-of-the-mill, I don't know if that's the right word, large cap company here that we have here right now. But that gives you a sense there. One thing I would point out to you is to check the percentage of shares outstanding that are in the short interest category. So the number of short interest shares out there, that can be a key factor, because for a short interest is basically telling you how many people are making trading decisions based with the belief that that stock is going to go down in price. Well, the higher the number means more people believe that company is going to go down in price. Generally, that's probably not a good thing. 3% is not a astronomical number. It's not a super high number, but it's not also super low. But if you start to see numbers that are upper, close to pushing 10% or something, 8, 10%, that probably is going to raise some question marks. And a lot of investors, I'm not telling you what you need to do, a lot of investors will run away from companies when that short interest percentage gets closer to that double-digit percentage. A lot of times you'll see these meme stocks, and they have a much higher number. We'll go back to GM in just one sec. Let's go to GameStop for 1 sec. I'm just curious what their short percentage is. It's actually not as high as I thought, but you can see we're starting to creep closer to that 10% here. Let me just do another one, AMC, and see what their short percentage is. 12, 13%. So you can see that is kind of in that kind of reddish area that maybe a lot of investors consider. Let's look at another one, and I want to mention this because this is one, Boeing, that gets asked about here a lot. Their short interest is relatively low. Okay, so it doesn't mean you may like Boeing, you may not like Boeing. But the issue with Boeing, and this is, I want to generalize this beyond Boeing here. The issue with Boeing isn't their fundamental data per se. It's that they've had some they've had some very discernible events that have that have lowered people's trust in the company, that aren't necessarily in the results, although it is showing in the results. And if we go through results, you can see their earnings have gone down, their sales have gone down. The question is, on a company like that, is it showing viable signs that it is turning around? And I don't know the answer to that, but you'd look at things like that and see if it is turning around there, okay? And you can read more about it in these analyst reports. Boeing had the strike. Of course, they hold the whole 737 MAX fiasco thing. Just, it's tough. But what happens is you get a company that has this depressed numbers. When they do turn it around, if they do turn it around, you can possibly buy for a much cheaper amount. Now let's go back to our stock in question, our example in question, which was General Motors there. Okay, and Cam, thank you for helping me out in the chat there. I appreciate that. Now let's go on further. You may invest companies based on a value approach, a growth approach. Maybe you're more of a dividend investor. Well, we have a dividend area here, down here too. Now I bypassed charts. And if you want to do technical analysis, I've done sessions on technical analysis on this. However, if you want to do this, if you want to do technical analysis, let me just mention that instead of relying on this chart on this page, this is just kind of the summary page. If you want more in-depth charting features, click on Show More. When you click on Show More, it will give you a chart where you can add studies on it. You can, you can zoom in. You can add data to it, including dividends. So I'm going to go to dividends in just a minute, but let me just show you this. If I click on Show More here, let's look at the dividend history. And remember, dividends can be discontinued. And I'm going to go for a longer term chart here. So instead of 6 months, let's go to, say, 10 years. Okay, here's 10 years. And I want to show dividends on this. So I'm going to click on events. I'm going to click on dividends. And you can see everywhere there's this like little black D square box. That's a dividend. And you can see throughout the history the dividends that have gone along. Now notice there's a gap in dividends. Now that was COVID, January, March, or early 2020 was COVID. And you can see, what did they do with their dividend there? They discontinued paying the dividend. Now that is one that's, for some investors, that is a kind of a red flag. Okay, they don't want to buy a company if they've discontinued the dividend. Now they have resumed the dividend. And it goes beyond the dividend payment. It's not just a whether you're going to receive the dividend or not. It's a matter of what that says about the company if they're cutting the dividend. Now, this was special times, the whole pandemic thing. So I don't know how to interpret that necessarily. But in the normal course of business, when a company has been paying a dividend and stops paying the dividend, that is usually an indication that financially things are not going along swimmingly there with that company, if they feel the need to cut the dividend. Because not only does it mean maybe they're bringing in less money, but they know companies are resistant to cut dividends typically because they know how it looks, how it's perceived among the investing public. So if they do that, it means they definitely need to they're definitely having some financial struggles. Now they have resumed that dividend. Typically, if you're looking for dividends, though, what you like to see is the dividend go up year after year, okay? So typically, you'll have 4 quarterly payments the same, and then if they raise their dividend, the next 4 quarterly payments will be the same, and then if they raise the dividend, and so every month we want to see it going up. 36-cent dividend, let me go forward a year. 38-cent dividend, they kind of increased it. 38 still, 38, they kept the dividend, 38, and then they completely cut it. When they resumed it, you just hover over it, okay? You just hover over it, 9 cents, 9 cents, 12 cents. They increased their dividend. Now, it's a lower dividend payment, and we'll get to that in just a sec, but they've increased it. There's a class of investors out there called dividend growth investors. They want to see that dividend payment increase, being growing year after year. This would immediately disqualify General Motors if you were in that camp there. Well, let me go back. I'm going to click on these little arrows here. Okay. So let's go and let's go on and let's go to the dividend section, which is going to be down here. Now, with all these sections, one thing I would mention is if you click on show more, you're going to get more detail on that. Okay. So you can see when the dividend dates are, you can see the past quarterly dividends. And of course, we already saw that in a sense on the chart. You can see the annual dividend rate, 48 cents. Now, 48 cents, that's not a quarterly payment, that's the annual payment. So you'd have to sum the 4 payments to get there to 48. And I think the last payment was 12 cents. So the assumption is it'll be 48 cents for the year. Dividend yield, just a little bit below 1%. So it's not a big dividend payer. If you were a dividend investor, and this may not be exactly up your alley there, but an extra percent in dividend may be meaningful. Let me click on show more, and you can see dividend payments year over year. So this is again getting at some of the similar information we got on the chart before. A different way to view it. This is the annual dividend. You can see the sum, $1.52 for the year, $1.52 for the year, and then they ended up cutting it in 2020, so you only had a partial year, and then they resumed it, and you can see it starting to go up. A lot of investors like to see that go up for longer periods of time. You can see over time what that's been historically. You can break that down, click on the little plus sign. You can also see growth rates in dividends and payout ratio. What's a payout ratio? So a payout ratio is this. A payout ratio is how much they're paying out in dividend in comparison with the amount of money they bring in earnings. Okay. Well, look, you don't want your company to be paying out every last dollar that they earn out to the public in terms of to their investors in terms of the dividend, because they need money. They want that earnings to be able to be reinvested in the company as well. So this is actually a very low number, 4.6%. But if it gets anywhere near 100%, 80%, somewhere in there, I don't know the exact cutoff you want to use, then it's probably a red flag. This is probably not a red flag here in terms of this, but there's a payout ratio if you want to see that. Okay. Let's move forward. Let's go past the dividends. That's the dividend area. Any questions on that? By the way, just in terms of dividends, if you want to be entitled to the dividend, you need to own it by the X date. Okay, you'll see it referred to EX date. Okay, you need to be, so if you did not, you had to actually own this stock on basically December 5th, and on opening of December 6th, be the owner of that stock in order to be entitled to that dividend, and that would be true for the next dividend payment as well. Okay, all right. Agariba says, why does a particular company pay so much dividends? So every company has to decide how much they want to pay in terms of a dividend. Some companies feel they need those earnings to, if they're a growth company, to really plow that money back into the company and for growth purposes there. And so that is their policy. Some companies maybe aren't growth companies, and they're generating a lot of cash. And you know what? Investors invest in those companies precisely because of that cash, and they want that dividend. So That's a reason that people will buy that company. I think that's a case there, Agariba, that you're asking for there. Some companies traditionally just pay higher dividends. Typically, they're not super big growth companies, but they're more established companies that generate a lot of cash. Okay, TM says, can you just own it on the X date and sell it? Now, you'd have to remember, you got it, the X date, you actually have to own it the day before the X date, but you could then sell it. Yes, you could. Now, you may be thinking, your head's turning. I can see your head there spinning and going, I found the perfect investing strategy. I'm going to buy the company the day before the X date, and then I'm just going to sell it, be entitled to the dividend, and capture that cash. It doesn't work that way, though, because what happens is that payment is a known entity, known quantity, and the stock on average will drop by the amount of that dividend payment on that date there. So you'd lose on average as much on the stock as you would gain by bringing in the cash on the dividend. Now, of course, the market there's a lot of other factors on what a stock does on a given day. It may go up more or go down more on that particular day, but that's why that strategy doesn't quite work as well, okay? So Sandeep is yes. The answer is yeah. You'll need to own it the day before. All right. But my suggestion, well, how do I say this? It's not as easy as just buying right before the date, capture the dividend and selling, because on average, you'll lose as much on the stock as you otherwise gain. Okay, let's move on from dividends. Okay, earnings. When you're evaluating a company, earnings is like the kind of takes center stage typically for a lot of companies. So you can see expected earnings right here, and you can see that's upcoming earnings right here, and you can see historical earnings as well. What we'd like to see is projected upcoming earnings going up. This is quarterly, and here is historical earnings. So for growth and for earnings investors, typically what they like to see is historical earnings growing. Those are the ones that are in the bank that we know, but also projected earnings growing. And you can see more detail, of course, if you click on Show More. Okay, so if I can click on Show More, I can see my earnings. I can see year over year. Again, we'd like to see it going up, and GM has been not spectacularly up, but last year's actually went up pretty well, okay? 2022 to 2023 has done quite well, okay? Before that, struggled a little bit there. And you can see that reflected. 1 year, 31% growth rate. 3 years, and this is annualized, 19%, 5 years, 6%. You can see the same thing with revenue. Ideally, revenue's growing. Ideally, earnings is growing. Ideally, cash flow is growing. So those are kind of three key pillars for a lot of growth investors, excuse me, that they like to see there. Now, if you're a value investor, are you likely to see super high growth rate? Probably not, because if you see very large growth rates in terms of earnings, sales, or cash flow growth, then, or all three of those, then likely people are willing to pay more for that company, which is going to drive up the valuations, and your common valuation metrics, such as a PE ratio, price to sales ratio, or something like that, are probably not going to be quite as enticing as they otherwise would be. So there's your earnings. Now we can see more earnings information. I'll show you as we get down the list here a little bit. We'll see a little bit more, but let me also mention this. If you want to look at it on a quarterly basis, you can click right there on quarterly there. Okay. And I want to just take a sec to reiterate something in the chat that Cam said, because Cam said it right. If any of you haven't seen our Schwab Equity Ratings or webcasts that we have on Thursdays, Adam Lynch, who teaches those typically, really does do a really good job. So I'm saying that. Cam said that in the chat, but for those of you watching a recording, you're not going to see that. It's very enlightening to learn about that. So check out that webcast. Okay, let's move forward here. Okay, actually, let me answer this question. What's GAAP versus non-GAAP? Good question, Sandeep. Okay, what's GAAP versus non-GAAP? So GAAP stands for Generally Accepted Accounting Principles. Okay, that is your standard earnings that companies release in their 10K, 10Q filings. Okay, that's their normal numbers, and that there's pros and cons to that. A lot of people find more confidence in that they're less able to be fudged, so to speak. I say less able because accounting you can kind of manipulate some data. In other words, when you're accounting, you can recognize, there's choices you can make in terms of when you buy things and whatnot, when you pay for things, that can affect that. But this tends to be less changeable than non-GAAP or non-generally accepted accounting principles. So why would anybody ever use non-GAAP? Let me give you an example of a reason why. Let's say you're a company and you have a one-time big write-off, okay? We'll say a big expense, okay? A one-time expense. It's not part of your normal operations, but it's a one-time expense. Or perhaps it's a one-time windfall. A lawsuit. You won a lawsuit and you have a one-time influx of cash into the company. It doesn't really tell you how that company is doing in terms of their operations. And so generally these one-time expenses or areas of revenue are excluded from the non-GAAP. And so they'll go, well, we're going to look at the non-GAAP because it's going to take out some of this one-time stuff. So this is kind of the standard GAAP, but sometimes people want to see what that non-GAAP is there. So great question there, Sandeep. That's what that is, though. Okay, let's move forward. And let me get out of here. So I'm going to click on my little double arrow deal there. Okay, and we're going to go down. Now, below earnings, this is another area with some good info. Oh, actually, before we go that, let me just mention some other stuff here on this earnings. You don't have to click on the show more on this next stuff I'm going to mention to you. Remember earlier, I mentioned a PEG ratio, and I talked about what a PEG ratio is. I think it's a very useful ratio. Okay? There's no one ratio, there's no one indicator out there that is going to tell you all you need to know. But if you want to see the PEG ratio, it's right there. There's also your PE ratio and your forward PE ratio. What's the difference there between your PE ratio and your forward PE ratio? Your PE ratio is, well, you guys, that's your price divided by your earnings, okay? Current price divided by your current earnings, or in this case, TTM is the last 12 months of earnings, trailing 12 months of earnings. A forward P ratio is taking the current earnings and taking the projected price. What's the expected? Sorry, I just totally reversed that. Okay, your expected earnings. It's taking the current price and dividing it by the expected earnings. Therefore, if earnings is expected to be higher, look, if you have a ratio, a PE ratio, and you think that earnings is going to go up, if that gets higher, that denominator of that equation gets higher, then that's going to drive down the overall equation. In other words, your forward PE ratio in that case is going to be less than what your current PE ratio is going to be. And that's what typically investors like to see. A forward PE that is lower than the current PE. The the more lower it is, the bigger the difference. The bigger the difference means the bigger the growth rate, expected growth rate for that company. All right? So those are some areas to look at in addition to that. Now, next section. Peers and ratios comparison. Okay. This is, at first glance, you go, this is okay. We can see a few data points here. This actually can give you a lot of data points, though. If you want to break them down on a more superficial level, perhaps, you can go and just click on, I want to see the valuation ratio. Well, you click on valuation, and it's going to compare your company to other companies that it wants to compare to. It has a Honda and Ford, okay? Nissan, Mercedes, right? So when you're thinking of a company, it's probably good to compare it to compare apples to apples. Not compare that company to, comparing GM to Walmart or Apple probably doesn't make as much sense. Okay? But so you can see that in terms of your valuation ratios. And a lot of these car companies actually have a lower PE ratio. Okay. You can compare the dividend. Here's that dividend yield. Massively high dividend yield on Mercedes-Benz. Honda, pretty high. Ford, pretty high. GM is kind of the outlier on that. That's not good nor bad necessarily, but if you really are seeking more dividends, maybe you start to investigate at least Honda or Ford or something like that. And so you can see these here. Fundamentally, you can look at the different areas here and compare some of these categories here. Debt to equity, that's a thing. We probably care about the debt of a company. And what I would say is, if your debt to equity is 129, that's over 100%, for a lot of people, that's a red flag, I'll tell you. Now, just looking at a number in isolation, it's tough to tell. So typically on a debt number, you're going to compare it to some of its peers, okay? Maybe the sector. I'll show you how to do that in a minute. Earnings per share forecast, you can see that there as well. Now, you can do the same thing with other areas. Consensus estimates, that's like analyst estimates, profitability, dividends, and so on. But let me show you this because I'm getting a little low on time and I want to get to it. If you click on Show More, what it's going to do is, it's thinking. We'll see if that can load here, because let me go back here and see if we can get this to, see if second time's a charm. Okay, we're going to do a GM here. Okay, that reloaded. We're going to go to peer. We're going to click on Show More and see if we can get that to load now. Okay. Well, it is not loading for me. Okay, so let me talk about it for a second. Hopefully while we're talking, it will load for us here. What I just showed you in terms of the peer comparison, you will see, except in expanded form and with more data on it, more data points on it, including future earnings per share, projected earnings per share, which a lot of people do like to see. I think it's valuable to look at that on a company. And again, let's say you see that and it piques your interest. You can check out one of those third-party analysts and see what they have to say on that. Okay? So, yeah, but this isn't loading here. But here's another thing I want to point out to you. On this page, if it were to load, what you would see is, and it's a little bit inconspicuous, at the top it says, I can't remember exactly, it says something like stock, and then it says, I think, index, okay? If you click on index at the top of the page, I can't because my computer is giving me the little circle of little wheel, that's hamster wheel or whatever. But if you click on at the top of the page where it says index, it's easy to miss, but it's pretty cool because what you can do is you will see the stock and it will compare it to its sector or industry there. So you can see, oh, there's the stock's PE. Here's the industry group PE. Here's the stock's debt level. Here's the industry group debt level. Here's the stock's earnings. Here's the industry average for the industry. Because as I said, you're not really comparing apples to apples if you're not looking at within the same kind of area there on that. All right. So there's that. Now, hopefully, let me go back here. Hopefully we'll get their next page to load here. Okay. So remember, right there, you click on Show More, you're going to get more information on that. And things aren't loading right now here. So I'm going to go. Here's your financial statements. Now, if you are an accountant, if you are really a financial analyst, and this is really of interest to you, then you may want to delve into financial statements. For the average investor out there, what we do is this. We take the information in the financial statements, see if it gives it to us. Right. It really should be available. I don't know why it's not available. Okay. Let me just bring up a different stock here. We'll try a different one in the group. Ford Motor Company. It's not, I'm sure that's there. I've seen it before on these companies. Here's Altria. Yeah, for some reason it's not loading for me. I know that there are financial statements that are there for these. And when you click on these, this gives you a very detailed breakdown. Now, for a lot of investors, when they look at this and they see that, the breakdown, it's like reading Greek, so to speak. They don't, assuming you're not a Greek, you don't know Greek. It's just hard to interpret. But if you are familiar with accounting and financial statements and this is where you can find the more in-depth information on those. And then finally, if you scroll down to the bottom of the page, there's a technical area. So it's not, again, that's not loading there. That technical area, by the way, I would submit, may not be necessary for you if you're comfortable reading the chart, where you can do your technical analysis right up here on the chart. Just do that, click on Show More, do your technical, and that's not even loading right now either. So, but you saw that earlier. You can do your technical analysis on the chart, but if you like, you can check out that technical analysis section at the bottom of the page. All right, so let's kind of just review here what we did. We talked about analyzing stocks, okay? Using financial analysis of stocks, okay, or what we call fundamental analysis. The Schwab platform is a great place to do it. Find your stocks first. I showed you one way, just doing one of those pre-built screeners. Great, but maybe that's not how you want to do it. Maybe you hear a stock from somewhere else. Maybe it's a stock that's already in your portfolio that you want to evaluate. Great, do it. Go through the process. I gave you the starting point. You can then take it to the next and go through, and maybe there's some areas that you care more about. If you're more of a dividend investor, focus on that. If you're more of a value investor, focus on that valuation area. And there you go. So play around with it there. Thank you for joining me. Thank you, Cam, for helping me out. Make sure you check out, if you haven't subscribed to the Trader Talks webcast on YouTube yet, make sure you subscribe. That should be in the bottom right portion of your page. And if you've already subscribed, don't click on subscribe again, because you'll probably end up unsubscribing, and we don't want that. Also, if you like the video, we do invite you. Feel free to click on like there. We'll look forward to, I'm looking forward to the next year with a new webcast, a few new webcasts. And this is our last webcast of today. I want to thank you each for joining me. Hope you all have a great rest of the day, and we'll see you tomorrow. Bye-bye, everybody.